Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AXSOME Therapeutics INC quarterly report. AXSOME Therapeutics Inc. offers a diverse range of products and services in the biopharmaceutical industry. Their commercial product portfolio includes Auvelity dextromethorphan for major depressive disorder Sunosi, solriamfetol, for excessive daytime sleepiness in patients with narcolepsy or obstructive sleep apnea Symbravo, Moesic meloxicam rizatriptan, or AXSOME for acute treatment of migraine. Their pipeline includes investigational products. AXSOME dextromethorphan for Alzheimer's disease agitation and smoking cessation, AXSOME reboxetine, for narcolepsy AXSOME esreboxetine, for fibromyalgia and other conditions solriamfetol for attention deficit hyperactivity, major depressive, binge eating, and excessive sleepiness associated with shift work disorder. Additionally, AXSOME has a research collaboration agreement with Duke University to evaluate AXSOME in smoking cessation. AXSOME Therapeutics, Inc.'s stock price has surged by over 52% in the past year due to a combination of strong product growth, successful clinical advancements, and positive market sentiment. Key drivers of this increase include robust commercial performance. AXSOME's CNS disorder treatments have reported substantial revenue growth, with Auvelity experiencing a 69% year-over-year increase in net product sales. Positive clinical milestones. The company has achieved significant milestones, including the settlement of a patent lawsuit concerning Auvelity and positive Phase 3 data for AXSOME in narcolepsy. Analyst endorsement. Wall Street analysts have maintained buy ratings and raised price targets, with an average 12-month target of $178.20. Confidence in financial outlook. Despite a net loss in Q3 2025, AXSOME's strong revenue growth and increasing cash reserves have instilled investor confidence. These factors collectively contribute to the company's growing reputation as a leader in CNS disorder treatments, driving its stock price upward. The primary drivers of revenue growth or decline in a company are multifaceted. Regulatory approvals, clinical trials, manufacturing and supply chain issues, pricing and reimbursement changes, competition from generic alternatives or established companies, market acceptance, licensing agreements, government regulations, and operational management all play significant roles. Regulatory delays can hinder product launches, while successful approvals can boost revenue. Clinical trial failures or inefficiencies can lead to significant losses, whereas successful trials can drive growth. Manufacturing issues, supply chain disruptions, and competition from low-cost therapies can also impact revenue. Market acceptance is crucial, as factors such as efficacy, safety, convenience, cost, and availability of adequate coverage or reimbursement can influence a product's success. Licensing agreements can provide access to new markets, but unfavorable terms can limit growth. Effective operational management, including personnel recruitment and retention, compliance with environmental laws, and successful implementation of business plans, is also essential for revenue growth. In contrast, government regulations and legislation can impose price controls, regulatory burdens, or other restrictions that may hinder revenue expansion. Net income and profit margins. A declining trend. The company's net income has continued to decline, decreasing from a loss of $212.3 million in 2024 to a loss of $154.6 million in 2025. This downward trend is attributed to various factors, including potential tariffs on imports and most favored nation drug pricing policies, increased competition from generics and similar products, and mandatory additional rebates and slash or discounts. As a result, profit margins have also declined due to the aforementioned challenges. The company faces significant risks and uncertainties that may further negatively impact its financial performance. Without any indication of an increase in net income or profit margins, it is clear that the company continues to struggle financially. The company's debt level has undergone significant changes over the past year. While total liabilities increased by 16% from $511,483 to $595,523, total outstanding debt actually decreased by 35%, from $180,000 to $117,642. Additionally, total current liabilities saw a substantial increase of 53%. This mixed trend makes it challenging to determine a clear direction in the company's debt level. In terms of interest expenses, there is no consistent trend. while interest expense decreased by $858 for the 3 months ended September 30, 2025, compared to the same period in 2024. It increased by $1,026 for the 9 months ended September 30, 2025. Overall, interest expenses have fluctuated, making it difficult to determine a clear trend. The financial performance of our company was marred by underwhelming results from international markets, particularly the European Union. Unfortunately, no segments or regions were highlighted for their strong performance, indicating a lackluster overall showing. The EU's poor showing is a notable concern that warrants further examination and improvement strategies. Management is expressing caution about the company's outlook due to various risks and challenges. They anticipate that growth will strain resources and infrastructure, requiring effective management to mitigate potential weaknesses in internal controls. The company's success depends on successful execution of its strategy, which involves managing growth, collaborations, and financing. Management is aware of the potential for material weaknesses in internal controls and is working to address these issues. Overall, the tone suggests a focus on prudence and caution as the company navigates its growth trajectory. The company's financial strategy focuses on retaining profits to fuel operational growth rather than distributing them to shareholders. As a result, it has chosen not to pay cash dividends and instead utilizes its funds to support ongoing operations and expansion plans. This approach is further reinforced by restrictions in the Blackstone loan agreement that prohibit dividend payments or share buybacks. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights concerns regarding inventory buildup and supply chain disruptions. On page 19, it is mentioned that there are indeed concerns about inventory buildup. The data on page 23 shows a significant increase in inventory from $26,250 to $35,636 between December 31, 2024 and September 30, 2025, further emphasizing the issue. Moreover, pages 57 and 89 mention potential supply chain disruptions due to third-party failures or external factors such as commodity price volatility. Page 61, ongoing conflicts in the Middle East, tariffs imposed by the U.S. administration on pharmaceutical imports. Page 62, and climate change-related risks. Page 63. The reliance on a single warehouse maintained by one third-party service provider. Page 92, adds to the vulnerability of the company's supply chain. The potential for loss or spoilage of inventory due to extreme weather events, disruption of operations, and increased costs also pose significant risks. Overall, these concerns indicate that the company is exposed to various risks related to inventory buildup and supply chain disruptions, which could impact its ability to commercialize products on time. That concludes the financial summary for AXSOME Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.